Thank you for joining us today. Sorry for the short delay. I'm Mark Sobel. I'm the U.S. Chair of IMF. Today, I'm delighted to be joined by Bo Lee, Deputy Managing Director of the IMF. Last year, Bo joined me for discussion ahead of Glasgow and COP26 and the IMF's climate work at the time. So with COP27 fast approaching, we thought it would be a good opportunity to look at the IMF's recent work and thinking in the upcoming COP. I'm going to ask Bo a few questions to kickstart the audience discussion. That should take 20, 25 minutes. I've then asked two discussants to help lead off the audience portion with comments, questions from no more than 4 minutes each. Denai Kyriakopoulou, Senior Policy Fellow at the LSE London School of Economics Grantham Research Institute on Climate Change and the Environment. And Thomas Ostros, currently Vice President at the European Investment Bank, overseeing a range of the bank's work, including global development and energy, and formerly the Scandinavian Executive Director at the IMF. After that, we'll turn to audience questions. These can be submitted in the signal that you would like to ask a question in the chat box. And again, this is being recorded. So welcome back, Bo. Glad to have you here today.
Thank you for having me, Mark. It's a pleasure to be back.
Well, thank you. In our discussion last year, you highlighted that the IMF's work focused on three policy priorities: carbon pricing, green investments, and a just transition. You outline the fund's focus on carbon pricing in particular for COP26. So what does the IMF see as its key priorities for COP27?
Thank you, Mark. For COP27, our priorities are threefold. First, is still carbon pricing. International cooperation is urgently needed to arrest GHG emissions. Our research indicates that despite existing efforts, there is still a large gap in global mitigation ambition, and that's called ambition gap, and also an even larger gap in global mitigation policy, and we call it an implementation gap. That is why the IMF is still advocating for an international carbon price floor among large emitters. We call it ICPF, including for both advanced and emerging markets economies. We believe the ICPF should be fair and balanced, with prices varying by countries' development levels. While we believe that carbon tax or emissions trading is the most efficient instrument, countries may use other equivalent measures, like feebates or regulations, to achieve similar outcomes. Our second priority for this year's COP is to ramp up efforts to meet the climate financing needs of developing countries. Advanced economies must meet or exceed their pledge of $100 billion a year in climate finance for developing countries, and ensure that a fair share of these funds goes to adaptation. And in parallel, we must harness trillions of dollars in private capital by removing barriers that dissuade investors from investing, especially in emerging markets and developing countries. Public sector and multilateral development banks could play an important role here by offering first-loss investments, equity capital, or credit enhancements. Our third priority for this year's COP is that countries need to continue to ensure that climate policies are fair and inclusive. Adequate support is needed for low-income households, workers in emission-intensive sectors, and regions which are most affected by the transformation. Proper revenue recycling, including for investments in green energy or lowering burdensome taxes on work effort and investment, can boost the economy while ensuring an equitable reform. Thank you, Mark.
Well, thank you. That's a good outline of many of the issues I plan to talk to you about. So let me just turn to the second priority you listed last year first. So in the context of green investments, as the second focal point of the fund's policy priorities, again, that you mentioned last year, I noticed that the IMF staff issued a paper in late July entitled Mobilizing Private Climate Financing in Emerging Markets and Developing Economies. So this paper is part of an excellent set of IMF staff climate notes, all of which can be found online on the fund webpage. I also understand in the same spirit that the fund will launch a new chapter of the October 2022 Global Financial Stability Report on scaling up private finance for climate in emerging markets and developing economies. There's going to be a live stream panel on Friday at 10 a.m. On the IMF webpage on this. So I had a sneak peek at the paper, thanks to you, and it discusses opportunities to scale up private financing, including new finance instruments and broadening the investor base. So could you tell us a bit about the opportunities that will be discussed on Friday at this live stream panel?
Thank you for the question, Mark. As you mentioned, our forthcoming GFSR, Global Financial Stability Report, there is a chapter that shows that sustainable debt markets, including bonds and loans, have developed rapidly in recent years. And a key driver for this encouraging development is the strong investor interest in sustainable assets. But as we see it, there are still tremendous challenges. Let me give you a few examples and numbers. Estimates vary, but between $3 to $6 trillion per year until 2050 may be needed for investments in adaptation and mitigation. But the current level is around $630 billion a year, with little going to developing countries. Investments by ESG funds, more than half of which are equity investments, have increased rapidly. But the climate impact of these investments is still unclear. The GFSR chapter finds evidence that firms in emerging market and developing economies have systematically lower ESG scores. And as a result, ESG funds have very low allocation to sustainable assets in these countries. Only about 5% of their assets under management are invested in EMDs. The change in pricing environment, that is higher carbon price, is good news for renewables and green technology. But the pricing change is occurring too slowly. And some people are worried that it's also occurring too late. To attract private capital for green investments, the most essential condition remains proper carbon pricing. Without the proper price signal, I'm afraid that other measures will never be enough. Of course, even under the most optimistic scenario, carbon price will not be ideal for many years. Therefore, our GFSR chapter highlights some specific financial instruments that could help to scale up private climate finance for developing countries. One such instrument is Green Fund. An example of this is the Amundi Planet Environmental Project, set up with the support of World Bank's International Finance Corporation. Such fund has great potential. They can tap vast resources of institutional investors, such as pension funds, by using relatively limited public resources, money, that was raised through this green fund. In this green fund that Amundi and IFC set up, there was 16 times money raised from private sector based on the initial investment by IFC of the equity tranche or the subordinated tranche of that fund. So there is a 6-time leverage in that fund. To attract private finance at the scale and speed required, the public sector, including the multilateral development banks and development finance institutions, will have to provide risk absorption capacity, such as equity capital, first loss investment, or credit enhancements. Currently, MDB's climate finance from own resources crowds in only 1.2 times the amount in private finance. To mobilize more private capital, MDBs could use more equity financing to a greater extent, which could potentially leverage private capital at large scale, just like the Amundi IFC Green Fund. The GFSLR chapter argues that the current use of equity finance by MDBs, only 1.8% of total climate finance commitments in 2020, should be much higher. I stop here. Thank you, Mark.
Okay, well, thank you. That tees up my next question. So last year when we talked, the fund emphasized, as you'd expect from good economists, that pricing incentives are key to meeting the Paris climate goals. You noted that the average global carbon price was $3 per ton, and yet it needed to be $75 to reach the Paris goals. And then you proposed this differentiated set of pricing that you've already referenced again today. It was $25, $50, $75 for key emitters such as the US, Europe, China, and India. So would you like to comment on how you feel whether progress is being made on this front? And you've already suggested carbon pricing remains a key focal point of the fund's work. So could you elaborate a bit on where you see pricing standing?
Thank you. As we argued last year, a combination of policies is needed to decarbonize our economies while minimizing the domestic macroeconomic and political economy challenges. A key priority is the right policy framework to accelerate the transition to low carbon economies. A well-designed carbon price enforced by sectoral measures like fee-based and in combination with green investment provides the most effective incentives to accelerate low carbon transition. Well, there is some progress since last year. Last year, the average global carbon price was $3 per ton. And 1 year later, it's now $6 per ton. Of course, the gap is still large because we need that price to go to $75 per ton by 2030. We're also seeing progress in other fronts. Last year, 22% of emissions were covered by a carbon price. And 1 year later, now up to 30% are covered by carbon pricing. But as you can see, the gap is still very large. And countries and the international community need to act now. Carbon pricing may seem impractical at this time when governments are rightly implementing targeted measures to help low-income households cope with sharp spikes in energy prices. But over the medium term, as energy prices recede from peak levels, as predicted by many market players, a predictable and steadily rising carbon price would incentivize a shift away from carbon-intensive fuels that have frequently been subject to price volatility and supply disruptions. And it would incentivize the large-scale redirection of new green investments towards renewables and other clean technologies at the scale required. As mentioned before, an international carbon price floor among large emitters would facilitate coordination of mitigation policies, allow global mitigation to be scaled up rapidly while addressing carbon leakage and competitiveness concerns. It will also complement climate financing goal since carbon pricing policies are a prerequisite for mobilizing large-scale private capital to support climate initiatives. I stop here. Thanks.
Well, let's cover the bases then on the three priorities that you mentioned to me last year. So last year, as I said, you mentioned the just transition. You mentioned last year the importance of progress on advanced economies meeting the goal of mobilizing $100 billion per annum in climate finance for developing economies. You already alluded to this at the beginning, but could you amplify how is this coming along? How do you see the just transition?
Thanks. As discussed, climate financing needs are indeed very large. The advanced economies pledged to mobilize $100 billion a year since 2020 for adaptation and mitigation projects in EMDEs. Well, the estimated flows from bilateral, multilateral, and private sources in 2020 were about $83 billion. That was $17 billion short. In addition, some public finance may reflect relabeling of existing funds, and systematic data on private flows is lacking. The climate finance delivery plan prepared by Canada and Germany for COP26 last year suggests $100 billion per year could be reached by 2023. That's next year. Still, the $100 billion a year will not be nearly enough. That is why we need more private capital. Private capital does not flow to EMDEs for multiple reasons. These include very low carbon price, high upfront investment costs, technical challenges, a long investment horizon, and unproven business models. Altogether, they add up to a risk premium that does not justify the reward. That is why blended finance, combining capital from public and private institutions, can play an important role by reducing the risk premium for investors. For example, as mentioned before, the public sector could offer first loss investments, equity capital, or credit enhancements. Of course, blended finance must carefully avoid privatization of gains and socialization of losses. Multilateral development banks will have an important role to play. By dialing up equity investments and other credit enhancement instruments, MDBs could make scarce public resources work work better by mobilizing more private capital. The IMF can also play a catalytic role in climate finance through our policy advice, surveillance, program lending, and capacity development. We also hope that our new instrument, the Resilience and Sustainability Trust, RST, will provide long-term finance to catalyze resources from all sectors. Thanks.
Well, thank you for that. Since Thomas works at a public institution and probably does a little bit of jump starting and catalyzing, I'm sure he'll have views on some of the things you just said. But to just ask you one more question before turning over to Denai and Thomas. And it's just picking up on where you ended, which is on this resilience and sustainability facility to help low income and vulnerable middle income countries by providing them longer term finance to address some of the longer term climate changes. Could you so I read last week that there was a staff level agreement with Barbados, which may be the first to come. Can you tell us a bit about this? Is it an RSF, Resilience and Sustainability Facility, or Trust, or either, whatever, including, can you tell us how big it'll be, how it's going to operate? When do you expect the Barbados loan to go to the board? And are there others lined up? Can you tell us about this?
Thank you. Indeed, we use both RST and RSF. RST is the pool of money. We call it RST, Trust. But when we use it for a specific country, we call it RSF. It's a facility, Resilience and Sustainability Facility. Let me give you some update. Our goal, the fundraising goal for RST is to secure, in the first phase, about $45 billion to meet expected loan demand as well as for an adequate reserve account. So far, we have received pledges of about $40 billion. Our goal is to use this money to support countries to catalyze private finance. So the dream is for the $45 billion to mobilize hundreds of billions in private financing for adaptation and mitigation in our member countries. Not only in additional private financing, we are also hoping our money can also catalyze other public institutions, MDBs, to join as well. Discussions with several countries on legal contribution agreements to formalize these pledges are making progress. Our aim is to operationalize the RST or RSF around our annual meeting this month. As you just mentioned, just last week, we reached a staff-level agreement with the authorities of Barbados for the fund's first RSF program. According to the agreement, which is subject to the approval by the IMF Executive Board, Barbados will get access to more than $180 million under the RSF, and an additional $110 million under a 3-year extended fund facility. Our financial support and the authorities' reform measures are expected to catalyze financing from other international financial institutions and also from the private sector to support Barbados' ambitious goal of transitioning to a fully renewable-based economy by 2030. We are grateful to all countries for their contributions to the RST. Their generous contributions will support low-income and vulnerable middle-income countries build resilience to longer-term structural challenges such as climate change, and pandemics. The RST loans will be concessional, and with a very long maturity of 20 years and 10.5-year grace period. So they are very favorable terms. I stop here, Mark.
Good. Do you have more countries lined up for the RSF or RST?
Yes, we are in our pilot phase. I think in the next 1 or 2 months, we can have at least 2 more countries that we will announce staff level agreement. That's our hope.
Well, great. Thank you for that. So, Denai, over to you.
Thank you, Mark. And thank you, Bo. This was really interesting and a very good overview in terms of where we are on the climate agenda. I'll offer 4 points in response to what we've heard. You opened, Mark, by talking about this discussion at the time before COP26 last year, and now we're having it before COP27. Obviously, we're in a very different world now than where we were last year. The economic, monetary, and fiscal constraints on policymakers are much tighter now. And also there is much more fractured geopolitics, and climate is a global issue that requires global cooperation. The case is still very strong for public investment in climate change. If we don't take climate action now, these constraints will only keep getting worse. The planetary boundaries haven't changed in the meantime, but how do we bridge these increased constraints on the monetary and fiscal side with the existing and even worsening constraints also on the planetary side? I think that will be really important for COP27. When you talk to finance ministries, climate is not as much the top item on their agenda as it used to be at the time of COP26. So it'd be great to hear on this. Second, your focus on emerging markets and developing economies, absolutely spot on. You cannot overestimate the importance, the systemic importance of EMDs in this transition. When you look at a projection of a baseline business as usual scenario, the emissions in the developed economies stay more or less the same. It's really where from the EMDs that the growth in emissions is coming from, and we need to catch them at this strategic moment and help them leapfrog, etc. But as the report that Mark referenced that came out in July, this very good report by the IMF highlights, and you mentioned it just now, that we should also avoid privatization of gains and socialization of losses. How do we avoid this kind of moral hazard questions, the taking on more risk by the public sector and the MDBs? You mentioned a lot of instruments, first loss, blended finance, de-risking, etc. But isn't it also important to also boost local capital markets in EMDs? The report also mentioned the risk of EMDs taking on more foreign debt, exchange rate developments, etc. So how do you see that agenda of local capital markets? Number 3, you spoke about the importance of the MDBs, absolutely key. The IFC is really seen as one of the institutions that is better than others in terms of mobilizing private sector finance. How can we get more development institutions to be more like the IFC? Thomas can tell us about the EIB as well. You have the Green Hydrogen Fund, very good initiatives there as well. But when we look at where we can get scale, there are open questions about the commitment of leadership, for example, from the World Bank on the climate agenda. So how can we get more institutions to focus on this? And final point is on energy. Looking at the energy transition in the minds of many policymakers, this is now much more about energy security than it used to be. And we hear a lot about the effects of this energy crisis. It's creating different reactions. On the one hand, there is the need to support consumers, as you mentioned, and keep the lights on. It's having the effect of accelerating the shift away from dependence and fossil fuel dependence. But at the same time, we are beginning to hear policymakers be more concerned about shifting from one type of dependence to another, and perhaps shifting too quickly to renewables, given that the supply chain and the critical minerals that you need to manufacture a lot of this wind and solar infrastructure are concentrated in countries controlled by a small number of countries, notably China. And it was interesting to see on the official IMF program for next week at the annual meetings, you have a session on this in the program. So it'd be good to hear also the importance of energy efficiency as part of the reaction to that and what you think about this. Thank you.
Thanks. So let me let Tomas go and then I'll let Bo respond to them if that's okay. All right.
Thanks, Mark, and thanks to Deputy Managing Director Bo Lee for his statement. I must say I agree a lot with what you said, Bo, and I think it is so valuable that IMF takes an intellectual lead on sort of the macro scenario when it comes to climate change debate, because we are really in need of that type of guiding poles going forward. So EIB is very much on the micro side, of course. We do project finance. And we decided a number of years ago to take the lead among the MDBs when it comes to climate finance, to transform the bank into a climate bank. And we have taken some decisive steps in this. I mean, we decided to have 50% of our lending annually going directly to climate-related investments or environmental sustainability-related investments. The rest of the 50% of the lending should be totally Paris-aligned. I mean, it might be health, it might be social issues, but it should not work against the Paris goals. And we are actually reaching the target, I think, beforehand, the year that we posted. But we also took a decision a couple of years ago to stop all lending to unabated gas, oil and coal-related energy production. And of course, in this environment, that might be a challenging decision because now everybody is talking about getting access to gas. But being a long-term investor, we have decided to stick to these goals because there is a tremendous need to have financing now of renewable energy and energy efficiency, and that is steady on that and do not divert from that path. This is our goals both inside and outside EU. So outside EU, of course, we are heavily now active in Ukraine, providing 2.5 billion euros since the outbreak of the war, and starting to plan together with Ukrainian authorities what are the type of investment needed to build up the country going forward. But Africa is, of course, also very much in our focus, also there with renewable energy and just transition in our focus. To give an example of how important it is with the carbon pricing discussion, because I totally agree with Bo. I mean, we need, if we're going to have a globally efficient transformation period, we need to have credible carbon pricing. Otherwise, it will be very challenging to meet the goals. We have now internally, as a shadow price, when we do our calculations on a road investment or something else, we use carbon pricing, shadow pricing that are sort of coincides with the goals 2030 and 2050. So we go from 80 euros per ton for carbon dioxide to 800 euros per ton of carbon dioxide in 2050 when we do our internal calculations whether we should be involved in a project or not. So we are trying to put that into our DNA to see to that we really do investment that are giving value added. Finally, crowding in, as Bo mentioned, extremely important and challenging in this environment. I mean, we are no longer there in the search for yield environment. We see instead the investors becoming a bit more hesitant. And we will work very hard to try to find all innovative instruments to be even more efficient in crowding in. And I think equity funds for emerging markets related to climate impact, mitigation and adaptation is a way to go forward to really get the multiply effect that we need. So thank you very much for giving me this opportunity, Mark.
Thank you. And before Bo responds, just to encourage the audience, if you wish to submit questions, just signal so in the chat box and we'll come to you the best we can. Bo, please.
Thank you. Thank you, Professor, and also thank you, Thomas. I think very good comments and questions. Let me try to respond to some of the points and questions raised. I think the first question on the current challenge the fact that the monetary policy and fiscal policy are both in a difficult situation, and the space is limited for public sector, for public investment in climate. That is indeed a very challenging situation. What I want to say here is that there are many other public policies that can be considered without the need for tremendous public money, in the sense that because there are a lot of private capital, there are a lot of money need to be invested, pension funds, mutual funds, and there are a lot of savings globally. And how to channel those savings into climate, how to channel those savings into renewables and green technologies. I think that is a big public policy question. And if the policy is designed properly, of course, international coordination is also needed, because a lot of savings are in the advanced world. But we need to invest in EMDEs. So not only we are talking about domestic public policy, we're also talking about international public policy to channel savings in the advanced world into projects, into green technologies, into renewables in EMDEs. And this, I think, there is a lot of room. There is a lot of room to design those policies, and there is a lot of room for improving international coordination. And I will give an example later when we talk about MDBs. That's my first my thinking on the first question. On the second question on the role of local capital market, absolutely, I agree. I think for some EMDs, there is a big potential in developing local capital market to tap into their domestic savings, because some EMDs have high savings rate, like countries in East Asia, countries in oil countries. They have a lot of domestic savings. How to develop local capital market to tap into those domestic savings? I think that's a very interesting but also important question that authorities should consider seriously, and also international community can also help these countries to develop a robust local capital market to tap into domestic savings. And also, if they do it well, they can also tap into the international savings. So a development of local capital market could be a potential policy instrument that I just mentioned in my previous answer to the previous question, that one of the public policy authorities could consider is to develop local capital market. And the international community should help EMDs to do that. Of course, for some other EMDs, they may not have enough domestic savings. And so in addition to capital market policy, there should also be policy in terms of encouraging domestic saving, and also better if the market is open to the international market, it could also attract international savings. So this, as you can see, is not only a matter of local capital market policy, but also it's also a question of whether there is a proper macroeconomic policy in place to encourage savings. The answer to the third question on MDBs, I very much agree with you. MDB can play a very important role, as I said, to mobilize global savings into renewables and green projects in EMDs. And the MDBs, they were created to help the development of EMDs. Now, an important part of that development, of course, is green development, is renewables. So MDBs should play a very important role immobilizing global savings and to invest those savings into EMDs. And in that front, I think MDBs can do more, because as we can see, there are so many savings piled up in many countries, including advanced economies, and also some other high savings countries. And there are ways to channel those savings into EMDs. And these ways, a lot of it has to depend on MDBs. So instead of, there are those high savings countries, they invest in, in the U.S. Treasury or in highly rated, developed market government bonds. Can we attract some of those excess savings into EMDE green projects? I think that's something MDBs can consider by issuing green bonds. They can attract those savings, and by using those proceeds of the green bonds into EMD green projects, MDBs can successfully channel money from savings from high savings countries into EMDs. In addition to that, as I mentioned, to play a bigger catalytic role, we need MDBs not only to invest in terms of loans and credits. They should also think about how to provide equity capital, how to provide credit enhancements, so that a lot of private capital can go together with MDBs. That's what we call a bigger catalytic role. And we think MDBs also have a lot of potential in that front, as among the IFC deal shows. And
Bo,
finally,
could I interrupt you there?
Yeah.
If you please excuse me. But one of the participants today is Margaret Kulo, one of my favorite people, and she wrote me a message saying she's at a conference in Geneva, so she can't appear by show her face. But she said that the conference is discussing precisely this issue about private investors having increased interest in investing into the transition, but concerned about slow movement and the like, and that there's concern about MDBs and DFIs moving too slowly with some of the risk instruments that you've mentioned today, and enabling institutional investors to invest more in emerging markets and developing economies. So you just spoke about the need for the MDBs to do things, but her question was, how can the IMF encourage policymakers and IFIs and MDBs to take up more concerted action in this area?
Well, IMF, as I just mentioned, we are doing our Article 4 consultation, our policy advice, our surveillance, our capacity development, and also our RST. And we hope all this together can play a catalytic role, because if we invest, if we design a program, other investors, including MDBs, including private investors, will feel comfortable to invest, because they will know that IMF has put together a proper framework, a program that we will continue to monitor, and we will do regular review to make sure the country who receives the money are doing the right policy and doing the right reform. So we regard our program, including our RST, as a catalyst to attract more investment by MDBs and private sector investors. So that's what we do, and we continue to do it. And we hope this RST can grow bigger and bigger. As I said, initially we are hoping to reach the $45 billion mark in the near future. Let me briefly touch upon two other points raised by Professor and also by Thomas. One is on the energy security. It is correct that energy security is a challenge given the current environment. But the answer to energy security challenge is not returning to the dirty energy. Our answer to energy security should be renewable and diversification. And given the current energy price, we regard it as an opportunity to move quicker to renewables. Because renewables, there is more than one kind of renewable. There is wind, there is solar, there is hydro. And when we have multiple kinds of renewables combined with some of the cleaner traditional technology like natural gas, there will be diversification. There will be more energy security. Because right now, if you rely heavily on the traditional energy, you don't have energy security at all. So that's why we regard it as an opportunity instead of a challenge. And finally, I think I want to quickly echo the point raised by Thomas on how multilateral institutions can crowd in, can play a bigger catalytic role. And I think we, multilateral institutions, including IMF, we play a catalytic role in our own ways. IMF playing catalytic role by designing a program, by providing the continuing monitoring, by working with the authorities to ensure a proper mix of policy in place that will make investors comfortable. So we regard our catalytic role as a combination of policy advice, program design, and also RST money lending. I think for MDBs, they can also play a catalytic role, again, by doing their due diligence, by providing their expertise. If MDB is in, other private investors may feel more comfortable to get in. But in addition to that, we think the Amundi deal, the Amundi IFC deal provides another example of catalytic role, that is IFC and EIB as international public body, they take the subordinated tranche of that fund. It's like the equity tranche. Then the other private investors will come in, and there was a leverage of 16 times. That shows that public money can be used wisely to leverage up. And that is why we talk about equity investment. We talk about public sector to provide risk absorption capacity. Because without those risk absorption by public sector, private sector, their calculation of risk return does not justify their big investment. So that is why public sector money can be smarter and can play a bigger role in terms of leveraging private capital. I stop here.
Thank you. Okay, so we have limited time. There's 2 questions. I'm going to call on the questioners to make their questions very short and sweet, strictly questions. So the first person who has a question is Anka Bogdana Rusu. Could you unmute yourself and show yourself and ask your question? And then I'm going to turn to a person who is labeled CHC for a very quick question. Thank you. Anka.
Sure. Thank you for that. I think I had 2 questions, but I think the one that comes more clearly to mind is IMF's thinking on using new technologies, AI, IoT, even blockchain to enable regenerative finance, and sort of moving past just carbon market credits to issuance of naturally backed assets, tokenized or not, and sort of opening up markets both for holding, for trading on balance sheet that could align incentives in more concrete ways beyond carbon. Thank you.
Thank you. And CHC?
Yes, thank you very much for this very interesting presentation. So 2 questions on my side.
What is your name?
My name is Claire Sonsitana from Abu Dhabi Investment Authority.
Please.
Thank you. The first question is with respect to the RST design and also related to the question of the necessity of developing local currency investments and local currency government bond markets. Why is the RST or the fund not seizing the opportunity of converting the rechanneled SDRs into the local currency of the borrowing countries so as to transfer the FX risk from borrowing countries to lending countries. And the second question is on the climate priorities. Certainly mitigation and adaptation or the way to go in the future. But this year we have close to 830 million and counting people undernourished. That's a point that the IMF has actually published in a recent blog. And that's also as a result of climate change negative externalities, fostered, of course, by the rich carbon emitting countries. So if we are in the need to actually compensate for these damages quite quickly, how do we go about that on a pro rata basis and in a trust or funds framework? Thank you.
Sorry, I didn't get your second question. Can you repeat your second question, please? Thank you.
Yeah. Yes, the second question, it pertains to the floods and the droughts that have certainly hit many emerging markets, notably in Asia and in Africa this year. And you can imagine that that is not the result of their own carbon emissions, but rather they are the victims of the carbon emissions of richer countries. And so it's all good to talk about mitigation and adaptation, but right now the priority is to actually feed the 830 million plus undernourished people who have lost their lands as a result of the climate change negative externalities. So we are more in a framework right now of emergency damage compensation needs. So how do we go about this from a trust or funds design perspective, and also which key do we actually compute to do a pro rata across countries? Thank you.
Thank you. Thank you. Now I understand your second question. Let me go to the with a reverse order. On your second question, the IMF board just approved a food shock window to our emergency financing instrument, precisely because, as you said, that we view this food crisis as something international community should work on. Of course, we are playing our part by we introducing this new food shock window in our emergency financing instrument. So countries in food crisis can apply for emergency financing from IMF. We, of course, IMF was created to deal with BOP, balance of payment challenges. So we address this food crisis from balance of payment perspective, because countries need to import food, and the food price is so high, and some countries are, in the middle of a balance of payment crisis because of the food price. So we address it from our angle. Of course, I totally agree with you that international community need to work together to address, because many of these food challenge, the undernourishment of a large portion of our population is not the result of their own emission, is the result of some other countries' emission or some other historical emission. So international community should work together to help these people. And we are doing our part. Of course, our part is far from enough. But I hope, as you do, that international community will continue to find solutions to help these people. That's my answer to your second question. Maybe you can remind me about your first question on the RST design.
Yes, and I'm just echoing a point that Danae was making also with respect to the need to transfer the FX risk from borrowing countries to lending countries. And in a sense, the RST is an opportunity for the fund to actually process the conversion of these rechanneled SDR into the local currency of the vulnerable borrowing countries, so that instead of effectively financing sustainable projects with unsustainable SDR debt, we effectively kill one bird with two stones, or the opposite, but effectively recognize the importance that the fund and other multilateral development banks should play in fostering local currency loans. Thank you.
That's a good question. I have to think about that because it's a new question that I have not considered before. But I may consult with some of my colleagues on this one. But I want to say as a general principle, we want to help our members to manage their balance payment risk, including the exchange risk. That's why we provide not only policy advice, but also other capacity development to help our members to manage their exchange rate risk, and also balance payment risk. But in terms of local currency loan and how it relates to our lending, that's a question that I may have to get back to you. But I think that it's a very interesting question. Thanks for raising that. Finally, let me get to the first question that raised by our audience, which is on the, I understand the question is that how to utilize technology, including digital technology, to facilitate carbon reduction. That's a very interesting question, and I can see many angles to that question. But again, that's a question I may have to get back to you. But from here, what I can see is that digital technology has a lot of potential, both in traditional financial market, but also in the market for carbon. And I think at least for me, I'm open to the utilization of new technology in designing our carbon transition strategy. I stop here. Thank you, Mark.
Well, thank you. We've gone a bit over. We started a minute or two late, so that's okay. But I wanted to thank you again for joining us today. Great presentation. I want to thank Denai and Thomas for offering great insights, as well as the audience with their questions. So thank you greatly. I look forward to hearing all about your activities at the upcoming IMF annual meetings, and hopefully COP27 is going to be a major success. Thank you for joining us today.